Thanks, Michelle, for coming back.
Of course. Thanks for having me.
Pleasure having you.
Yeah.
So if you don't know Michelle, she's one of the best mortgage brokers that I ever known and worked with. And I actually, first tried working with Michelle on one of my own properties. It worked out perfectly. So that's why I always, refer Michelle to all my clients.
Thank you. That's really nice.
So we're going to talk about the current mortgage trends and what we see in the mortgage environment and where the rates are trending towards, and of course what to watch for. We're going to get some tips that you might provide for any person who are out there trying to start their application or don't know where to start, and we go from there.
Sounds good. I'm ready to go.
Yeah. So tell us, what are you seeing in the market currently? Like, what's the mortgage rates, where it's trending towards, and what we should know?
Yeah. So the last time I would have been here was, I think, like 4 months ago.
I think it was December.
Before Christmas?
Yeah.
Okay, cool. A lot has changed. It's really exciting because we're finally seeing the variable and the fixed rate gap come together. We're starting to see them be almost identical, which is exciting for a lot of borrowers because it gives them the opportunity to choose product based on preference as opposed to simply based on what they can qualify for. In the past, there was just such a large gap on the fixed versus the variable rate that it was kind of forcing people to take fixed because they maybe weren't able to qualify for their loan size against variable. So that's something that I think is really exciting. We've also seen rates for the first time in a very long time start to edge into that 3% range. So we're seeing things in the high threes. And I know that that's really making a lot of buyers excited. It's taking a lot of pressure off for people who are coming up to renewals. And overall, I think we're heading in a positive direction relative to where we've been for the last couple of years with interest rates.
Yeah, that's for sure. Speaking of rates, actually, I did a comparison for a client of mine, and we were looking at the average sale price. I mean, average in all asset classes, detached, semi-detached, and condos. And we were making comparison between last year, this time, and then this year, with the respect to average sale price and then the mortgage rate. So last year, this time, the average Toronto would be around $1,170,000.
Okay.
And then right now we're looking at $1,107,000. So it's about like 4% decrease in the pricing. However, the rates have also dramatically changed from 5.5 last year.
Modestly.
This time I know, if you would get 5.5, you would be lucky. And now we're looking at, like you said, highs of 3s and lows of 4s, which is quite a significant drop. And in that comparison, we ended up with $869 less payment per month, which translates to $10,000 less payment a year, and then $52,000 on a 5-year term. So that's quite, significant change. And the way I kind of try to communicate with people is that if this math works for you, then I think it's the right time for you. But again, this is not a financial, statement or recommendation.
I'm really happy that you looked at it that way. And I think in general, more people really need to dive into the details. I think, Canada has very much been a real estate economy for a very long time. And I feel like it's all anyone's ever talking about. People are talking about interest rates, cost of housing crisis, too many people, not enough houses, whatever it is. And we see that on the news all the time. What does that actually mean? Not only in general, but for you specifically, because I think it's not fair to assume what the value of a dollar is for everybody across the board. And I actually looked at a similar comparison, and what I was looking at is per $100,000 against a 30-year amortization, for every 10 basis points difference in an interest rate, so 0.10%, that equals about a $5 a month payment savings and an $8 a month interest savings. Wow. So over $100,000 over the year, we're talking, $96 in interest and about $60 in payment. The reason that I think it's important for people to break it down, and kind of get really granular is because what does that mean for you? What does $96 or what does $80 mean to you? Is that the difference between you making a purchasing decision or not making a purchasing decision? I don't think it's smart for buyers, sellers to make decisions based on interest rates are high, interest rates are coming down, prices are coming down, the market's softening, whatever it is, because there's always some version of that, right? During COVID, it was like, everyone's going crazy, and through 2021 up until beginning of 2022, there's bidding wars on everything, and everybody's making it seem like it's the best time to buy a home. Those are the buyers or the people who now are, a lot of them, the most burnt. So I think it's really important to go in and understand, do I like this house? Can I afford the payments on this property? And am I going to listen to, oh, well, rates are going to come down a little bit more. Not that that's not great. We all want the lowest interest rate. We all want the cheapest price. But can you stomach, maybe being at a 399 today and understanding what the difference between a 399 and maybe a 389 that you're hoping for, what is the difference of that? And are you willing to give up this property that you love trying to achieve that?
And it's really interesting that how the mindset have changed. Like you mentioned, in 2021 and early 2022, everyone was rushing into the market. People would be looking at their brother, sister, neighbor, buying or selling, and the prices were going up. Like,
I know.
At some point, the prices went up for 15% in 90 days. This is insane.
I know.
This is not good to anybody. And now we're actually paying for it. And a lot of people who ended up, overpaying, as you mentioned, they're all now, feeling the pain. And what it's important here is to make sure that actually that math works for you and not rushing this decision, because you got to put the emotions aside.
I agree. And when you say not rushing, I think it's not rushing to or not rushing away from. True. Because I notice it on both sides. And I'm actually really excited about the market right now because, I was talking to a friend about this earlier. This is the first buyer's market I've really seen in my career.
I think since 90s. I mean, I wasn't doing business.
I was born in the 90s. You know what I mean? Yeah. So I wish I bought a house in the 90s, but it's nice for people to be able to assess the market, understand their financing, decide, hey, do I like this house? Let me go home and think about it and chat with the people that I care about to decide whether it makes sense for me to take this option or should I keep hunting and look at a different option. They didn't have that opportunity in 2021 and 2022.
And back then, one of the things that everybody was complaining about was a low inventory. So we would averaging between 2.2 to 3 months of inventory in all asset classes. Right now, we have 9 months of inventory.
I love that.
We have 5 months of inventory in detached homes. So that means the buyers have a lot more options. The buyers are holding the cards. And you get a lot more negotiating power. So this is what everybody was asking for back in 2021, 2022. Here we have it.
Here we have it, folks.
But because of all these noise and the news and headlines, and that's why I really wanted to do episodes like this, that we really drill down into those details, see what actually those mean on numbers based on the facts, not just the clickbaits. So no, that's great. And another topic that that's kind of hot these days is the renewals. Obviously, a lot of people took a lot lower rates 5 years ago. Now they're up for renewal. Everybody was kind of concerned about this renewal wall, but I guess this was a 2024 concern. Now that the rates are fairly stabilized and up to 4%, it's not that concern, but a lot of people are going to see a huge jump in their monthly payments. So what's your take on this, and what would you recommend for people watching or listening that are right now up for renewal or want to do refinancing? What's your basically 3 top advice?
Yeah. So renewals are interesting. And I want to preface this by saying banks and lenders trend differently. Their behavior trends differently in different economies, in different markets, etc., based on what's going on currently and based on the behavior that they previously had and whether that was successful or unsuccessful by whichever metrics they decide to measure that by. Today, what we're seeing is, and I know the mortgage brokers are going to hate this comment, we're seeing banks be really aggressive on client retention at renewal. And the reason that we're seeing that is, in this context, I love the saying, everybody loves the devil that they know. There is a lot of blood in the water. Default rates are higher than we've seen them. They're not astronomical by any means. Canadians really protect their real estate, but they're definitely higher than we've seen them. So a lender kind of tasked themselves with the decision, should I be more aggressive on trying to retain this client who I see and have a history of understanding that they pay their bills on time and they have caused us no problems? Or should I take a risk on trying to capture a new client and bring them into our banking institution? Typically, and over the last 8 years of my career, it has been very common for lenders to be more aggressive at obtaining a new client than retaining existing business. And previously, I've seen lenders offer better rates to new clients than to existing business. This is the first time that I've ever seen that not be the case. And I think it's for exactly that reason, is I have data, 100% I know Michelle has paid her mortgage. I would like Michelle to stay here versus me taking the same money and pushing it out to Bobby over there who like, sure, this looks like a AAA application, but I know that defaults are increasing. I know that there's so much fraud going on in the mortgage market that is riskier than me just staying with Michelle and staying on the straight and narrow. That is primarily true for banks. I'm talking, your major fives, maybe the odd credit union or two. If you are with a credit union, if you're with a monoline lender, depending on the mortgage bucket that you have or that your mortgage fits into, it may make sense for you to look elsewhere. It never hurts. Like I have clients that I've done mortgages for before, not done mortgages for before. They just reach out. They say renewal's coming up. The first part of my conversation is, what did your current lender offer you? And if it's astronomical, I'll go take this verbiage, bring it back to them. Let me know what they say. And sometimes it's just that opportunity for me to, validate them and say, hey, this is super competitive. You're not going to get anything better elsewhere. Sometimes when I give them a little bit of information and they go back and push their bank, what they want ends up on the table. Sometimes it doesn't, and then we pick up the mortgage and move it. So I guess you said top 3 pieces of advice. Find out what your existing lender's willing to price you at. Check in with somebody that you trust in the mortgage space. And that's a big one, like that you trust in the mortgage space, because there are a lot of people who wear the same hat that I do, who will just try to take your application in the door. I really don't want to bring you in the door if I don't know that I can do something better. I don't want to waste your time and I don't want to waste my time. So if after speaking with that professional, you're hearing that there's a better rate out there, take that conversation again back to your bank. Because when you take it back to your bank, that's when you're really going to know, are they interested in bringing this down, or are they going to stand firm where they are? Sometimes that threat of leaving will make them come down a little bit more. They're the most capitalistic institution that there is. And I think consumers like to forget that sometimes. They're like, oh, well, I banked with them for 50 years. Like, respectfully, no one cares, especially them. Sometimes they're going to try to see, is this somebody that I can push profit margins on? And sometimes you got to play a little bit of hardball and come back and close those profit margins down.
All they care is just making money. So, but no, here, those are pro advice. So yeah, and then actually I'm going to add one more point to it. Like, 2 cases. I mean, first one is myself, that I got my mortgage last year, and I think it was a 3-year term at 5.1%. And this past week I was able to break it, and now I got 4%. I think it's 4.09.
You did a 3-year?
Again, a 3-year fix.
Okay.
And that brought my monthly payment down by almost $600. And actually, when I was negotiating with the lender, and it was one of the big fives, which I'm not going to name here, but I got 2 options. One was to switch to a 5-year variable at 4.2%, if I'm not mistaken, and then 3-year fix at 4%. But the big difference was the penalties. Mm-hmm. So if I were to switch to 5-year variable, the penalties were like $10,000.
Okay.
And if I were to switch to a 3-year fix, the penalties were $3,000.
Mm-hmm.
So obviously I made a judgment call. I went with the less penalty, but it all made sense because $600 less payment. In half a year,
recouped the penalty.
I'm going to recoup the penalty and the savings from there. And there was a client of mine, actually, he was up for renewal, and he was able to negotiate with the lender and got a much better deal, and the others were actually offering him. So yeah, like you mentioned, negotiate with your lender, talk to a mortgage professional, and see what the best option is, because your monthly payment is what's actually going to dictate how you're going to interact with either holding the real estate or investing into it, and be able to take advantage of the situation.
Yeah, I would love actually just to throw something out there to the people not renewing, because the first example that you used is actually not a renewal, right? Your own is just like, hey, I'm in a high interest rate and interest rates have come down. Is there something else that I can do? These are very unique situations when you discuss them directly with your lender. Sometimes it may make sense for you to break that mortgage and fully go to another lender or bank. Sometimes you may be able to break a term and get creative penalty pricing at your existing lender. If you're somebody who is in a higher interest rate and you'd like to bring that down, you're struggling with the payments, you're seeing that there's opportunity to potentially have lower payments, open up that discussion with your lender. I think a lot of people are just like, I can't do anything because there might be a penalty. Figure out what's actually going on there. Every single banking institution has completely different rules in regards to that. Completely different rules. Some of them have things called replacement policies. I won't get into like the exact nitty gritty of when it applies and when it doesn't. It can get very complex, but just for kind of everyday people who are not trying to be experts and get a PhD in mortgages, understanding that phrase, replacement policy, maybe something that you want to go down the wormhole and try to figure out if it may apply to you. It could be you breaking a mortgage and not incurring a penalty if you stay at your existing lender. There may be stipulations that you would have to abide by in order to do that. That might be, hey, you need to increase your debt by at least X. So therefore, do you have a car loan or something that you want to wrap into that, which may also benefit you? So I just want people who are not coming up to renewal, but are maybe struggling with being in a higher interest rate, having higher payments, to understand that there's still maybe discussion opportunities. And then we're in springtime, and springtime for most lenders is cashback season, which means that let's say you do have a penalty. There may be a lender who will give you some cash back to help eat the cost of that penalty. Yep. They might not eat all of it, but if there was a $6,000 penalty and they could eat $3,000, and if you had $3,000 kicking around and it meant that you could save 1.5% on your mortgage, would that make sense to you? For a lot of people, when you dive into the numbers, that definitely makes sense for them. So
yeah, everybody looks at their monthly payment and eventually be like, well, if this is going to save me $600 to $1,000, why not?
Yeah.
No, that's great. One last question. Do you have any stories to tell us? I'm really interested. I know you always have some interesting stories, with obviously mainly in the mortgage industry, where you deal with a lot of people, investors, buyers, you name it. So always curious, like what's happening on your ground level, and like I want to hear some real life scenarios.
Okay, I always have stories. It's crazy the things that I see and interact with just sitting on the financing side of this. It's wild. I feel like I have a front row seat to just seeing every end of the spectrum, amazing and not.
You have a front row seat and the checkbook.
Exactly. So I'll give you a negative one, and then I'll finish it off with a positive one. The negative one is surrounding pre-constructions, which I'm sure you're not surprised by. There are a lot of people struggling with pre-constructions right now. Appraisals are coming back very low in the condo space specifically. And for people who purchased around that, 2021, 2022 timeframe, they just, purchased at a price point that is higher than what the property will appraise at now. Most lenders they lend you based on the purchase price or the appraised value, whichever is lower. There are these blanket appraisal things, or this concept that has come out within the last handful of months. I'm not clear on where it's applying, where it's not applying. I'm not sure if it had to apply at the time that you purchased it, or if it's something that some lenders are able to stack on after the fact, but let's assume that that's not the case. We're seeing appraisals come back light. Every developer or builder has their own rules as to what the down payment structure is on their development. Some of them will say, hey, in order for you to buy here, you're going to need to give us 20%. Mortgage lenders, however, may have a different set of rules as to how they can lend to you. Why this is important for people to know is just because your appraisal has come back light does not mean that you necessarily have to bridge a gap. So if you put down 20% on a property and you were expecting, therefore, to get a mortgage at 80% loan to value, but your property appraises light, and now the lender is acknowledging that price as opposed to the purchase price, your loan to value internally to the lender may now just be 85%. It's important to note that that's changing the bucket of mortgage. That takes that from an uninsured mortgage to an insured mortgage. An insured mortgage needs to be an owner-occupied property or a secondary home. It cannot be a rental property. So this won't work for people who already have tenants in there. But it's an option for people who've purchased for themselves, or who have purchased for, their aging parents to live in, or for their kids to have at university. Just because the appraisal comes back light does not necessarily mean that like you're screwed and you have to pull up with your checkbook. I'm not trying to paint the picture like that's not happening. Right. It is happening everywhere, but there are other little loopholes that you should explore before freaking out. The second example or story that I have is, so we would have seen each other, I think, just before there were two key rule changes, or right around that time.
Which we talked about it on our first
episode. Yeah. So the insured cap moved from 1 million to 1.5, meaning that you can purchase a property with a less than 20% down payment now under 1.5 million versus under 1 million before. And then 1 month later, there the CMHC essentially rolled out this program. It's called the 90% refinance program to add a secondary suite for a property with an as complete value of under $2 million. So that's a mouthful. What it essentially means is that if you're looking to add another unit into your property, a basement suite, a laneway house, a garden suite, whatever it is, you can refinance up to 90% of the as complete property value. So after you've added the suite, what is the value of the property? And we can do appraisals that would tell us what that would be once you add it in. This is really exciting because my investor clients are having a heyday with this. Because prices have come down, you're able to find single family homes, definitely some duplexes, some triplexes, even in the city of Toronto that are under $1.5 million. So I have a client who sold their home. They're coming out of that home with, I don't know, $500,000 cash or something like that. They have purchased or are looking to purchase, I don't think that has been accepted yet, $1.25 or a $1.3 million triplex in Toronto. The triplex is pretty run down. It's definitely going to need a lot of love on the 3 units inside, but it's already been approved and permitted for a laneway house, which is amazing. So they are going to need their $500,000 to cover down payment. Under this new insured cap increase, they only have to put 10% down because it's an owner-occupied property. They're going to be occupying one of the units, and it's under $1.5 million. That's keeping a lot of cash in their pocket for future renovations. As soon as they take over this property, we're then going to submit it for the 90% refinance program so that they can build that laneway. Oh, wow. The as complete value with this laneway added, it's going to go close to the 2 million mark, probably somewhere between 1.8 and 2. So we're going to completely finance that build by refinancing the as complete value. Once that's done, they will then have the additional cash left over from what they did not have to put down purchasing above $1 million, what they would have had to put down, before December 15th, I think it was, to kick off. I don't know if they'll get through all 3 units of perfect renovation in the house, but they're going to be able to renovate most of those. And once they start doing that, now the value of the property is again increased. And there's a chance that I can go back and just refinance it again under traditional means and get them the rest of the money that they need.
Yeah, that's smart.
So I'm loving those 2 programs together. Yeah. I think that they're creating so many cool opportunities in real estate. Yeah. Not only for investor clients, but first-time home buyers. That cap needed to go up for a long time. It's a lot to save a 20% down payment, $200,000, $250,000. Now that insured cap, I think, is more in line with the average cost of a home.
100%.
So like a young couple purchasing, they don't need to get that 20% to purchase in the $1.2 million range. It's really opening up opportunity for buyers to jump into the market.
Well, that's smart investment. That is real estate investment, not buying pre-construction at $2,000.
Yeah. And I think, you and I have talked about this a number of times. What is the definition of a real estate investor? Yeah. Like, I own real estate. I do not consider myself a real estate investor. Deals are made. They're not found. And that's why I think I'll scream it at the top of the rooftops. I'm not saying pre-construction is not a good investment for some people in some scenarios, etc. But I think people have this, 2012 mentality that I'm going to purchase this because the cost to build it is so cheap. And then by the time it comes to completion, the value of it will have increased significantly. And that was maybe the definition of some type of real estate investment a decade ago. Yep. That is not a real estate investor today. That is the ballsiest real estate decision. I spoke to a lady the other day who bought 2 pre-construction units that are coming to completion. She does not have enough income to close on them. She does not have enough money to close on them. And she said, the realtor said, guaranteed you're going to be able to assign this. And I was just like, oh my God, that's awful. And she's going to probably have to claim bankruptcy.
And most of those, I'm sorry to say it, but most of the real estate agents who are claiming that assignments will work and that people are going to make money, they haven't even done a single assignment. So they don't know even what the process is. And right now it's a bloodbath out there in the assignment market.
You probably know the rules on this a bit better than I do in the stats, but from my understanding, less than 50% of assignment sales actually go in a stable market because there's very strict marketing rules. Can you maybe just...
Yeah, so the assignments cannot be on MLS, obviously. So it's always on WhatsApp message groups or Facebook groups. And it's really difficult to really find... there are deals out there in the assignment market, but again, you have to be very, very careful. You need to know what you're doing. and you really have to have the guts for it. I don't advise, for people who are just trying to get to the market to start with assignment, maybe on some, occasionally on some cases, but not as a general statement that, yeah, you should, dive into the assignment market. And actually, going back to the pre-construction point, even if people cannot get qualified for this mortgage and they decide to walk away from their deposits, I don't think necessarily that's a good decision.
Oh, that's a terrible decision.
They are risking mitigation. They are risking a lot more, trouble down the road for them. They're going to be on the hook for, thousands of dollars.
Oh, way more.
And I know one case that project was sold out. A few people didn't close on it. They walked away from their deposits. Not even they got sued. Now the developer has taken over those units, brought them back to market, and sold them at market price, at today's price, not the 2017 price when they were selling this. So not even the developer got their deposits. They were also was able to sell it at a high price, selling 2017.
I think there's in general narratives. Like I see this all over the internet all day long. And although I am a business owner, I'm also a consumer. I'm also a Canadian. Like I live in the same world as everybody else in any job does here. There's this narrative that it's like, oh, we got to take down the big guy and whatever else. And I just want to make something really clear. When we're talking about development, the profit margins here are typically somewhere between 10 and 16%. The level of risk being taken on by developers, by builders, to get these projects completed and to create homes for us everyday people to live in is massive. We're talking about tens of millions, if not hundreds of millions of dollars worth of debt and leverage they're creating. There's hundreds and hundreds of people that are working for them, the construction people, they're sourcing things from, materials from different countries in the world. I think they deserve more than the 10% to 16% profit based on the level of risk that they're taking on. And you're going to be the one swallowed up as the consumer by trying to walk away. You need to do everything that you can to close on these units, because if you don't close on the unit and then the developer has to go resell the unit, if they sell it at the same amount that you purchased it for, there's a chance that maybe you get away, because the litigation there has to be a basis for it. So you signed that you would be losing your deposit if you walked away. That's likely going to go, but also the litigation needs to come in. There needs to be proof that your actions cause some type of financial damage. In this market, where you purchase something for a couple $100,000 more than it would be able to resell for today, there's hundreds of thousands of dollars worth of damages that they would be able to recoup. And then what are the interest costs and the other, behind the scenes costs that you can't see that they now have to carry as a result of you not closing? So a lot of people think it's as simple as, oh, I'm just walking away from my $50,000 deposit. It goes a lot deeper than that.
Yeah. No, 100%. And that's why I always stress that people need to have a group of professionals, everyone that works in their field, to be able to get a better consultation and better get an actual result out of this. So you need to have a proper mortgage professional next to you, a lawyer, accountant, your real estate broker that can describe what the market condition is. So that way you can actually make an educated decision, not based on emotions.
Absolutely. I wholeheartedly agree with that.
Well, thank you so much again, Michelle. It's been great.
Thank you.
Can we get your promise that you're going to be back soon?
Yeah, I like
Perfect.
It here.
Okay.
Quick to the point. We get things done. So
Awesome.
Thank you for having me.
No, thank you. It's been a pleasure.
Awesome.
Thank you everyone for watching, and we'll be back with more.